We wouldn't be talking about this so openly if it weren't already obvious. Before we get into this important relationship, let's look at what's happening in the world right now. There are major geopolitical changes taking place. Last Friday, November 7th, we saw another terrific move in the markets. The dip buyers showed up, just as expected. We saw this multiple times over the course of the last few years, however, this year it has gotten way more intense. Buying the dip at its core, it's a contrarian entry strategy. When prices temporarily decline within an ongoing uptrend, investors use the weakness to accumulate more assets at lower prices. The long-term trend of the market is upward. Therefore, short-term declines are opportunities and not warnings. Over the past 2 years, we've seen the stock market has doubled and performed incredibly well. Yet consumers are doing terrible. The consumer sentiment, measured by the University of Michigan, completely disconnected since the COVID crisis. The current levels are on the same level as in 2008, right in the middle of the great financial crisis. That is actually a terrible news. Specifically, during 2021, the stock market recovered to its early 2020 levels. However, consumer sentiment did not recover at all, only showing a tiny uptick, nowhere near its pre-2020 levels. After 2021, consumer sentiment experienced an even more severe decline. The level it reached fell below that of the 2008 financial crisis, an extraordinarily poor performance. Although there was a brief upward trend afterward, by 2025, amid the new tariffs, consumer sentiment has once again dropped to its lowest levels. Since early 2025, tariffs have acted like a mini negative supply shock, reversing the sentiment recovery, even as the market kept rising. After 2020, few big forces pushed financial assets far above the path of Main Street experience. First, the liquidity and monetary expansion. Fed slashed rates to zero and injected trillions through QE. Equity valuations inflated even as real wages stagnated. However, this is the reason why consumers took such a toll. It was due to inflation. The massive QE caused inflation comparable to the one in 1970s, and that's precisely the reason why massive quantitative easing can cause such a damage. This is the macro split between financial wealth and household welfare. Markets are discounting future earnings and see tariffs as temporary. Consumers live in the present tense economy: prices, wages, and job security. Here's how that disconnect gets fixed. Consumers eventually recover as inflation eases and real wages improve, meaning sentiment catches up. Markets correct when earnings expectations prove inconsistent with household demand, meaning stocks catch down, and the disconnect disappears. This is the most powerful factor for investors in equities. The mean reversion dynamic in equity returns, and the chart captures it beautifully. If we look at the chart, we're seeing that the orange line is the smooth momentum measure of market performance, not raw returns, but a rolling growth pulse. When it's above roughly 15%, it means the market has been compounding at an unsustainably high rate for several years. Historically, those points often coincide with valuation excesses, like in 1929, 1950, 1999, 2015, 2021, and right now. When it drops below roughly -5%, it reflects deep pessimism or panic. It's a multi-year underperformance. Historically, those are the best long-term accumulation zones, so that 15% to -5% heuristic acts almost like a behavioral sentiment oscillator, but grounded in realized price data. It's a form of return reversion, not price reversion. Over multi-year horizons, market returns overshoot due to liquidity and sentiment cycles. Then they mean revert toward the economy's real earnings growth and inflation, roughly 6 to 8% nominal. Historically, we can think of it as when the 3-year average annual returns are too good, the next 3 years are usually bad. When they're terrible, the next 3 years are usually fantastic. Right now, the past 3-year average annual return is 21%. That is a very high value historically, and given what we've just said, it could reflect an upcoming major correction. None of the information provided should be considered financial advice or an investment recommendation. Our goal is serving you the best educational content. Thanks for watching. This is Glenaius.